everyone. It's Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my North American opening market comment for Tuesday, June 7th. Well, the dollar continued to fall in the European morning trading, with commodity prices recovering. The Canadian dollar and Australian dollar were big winners, while in emerging market currencies, the South African rand was soaring. Sterling and the Swiss franc also gained, which is somewhat strange. Why would the safe haven Swiss franc be rallying if Brexit risks are receding? The yen was weaker too, which makes the activity in Swiss franc even more difficult to understand. In any event, there aren't any major indicators coming out from the U.S. today. From Canada, we get the IV Purchasing Managers Index for May. It's expected to fall somewhat, but remain above 50. That's in line with the Bank of Canada's existing view, which is that the economy slowed in May because of the fires. So it shouldn't have much impact on dollar Canada, in my view, especially if it stays above 50. Overnight, Japan's first quarter GDP is expected to be revised up slightly. That could be good news for the stock market, in which case it could push dollar-yen higher. In other words, weaken the yen, oddly enough. Still, it's not likely to be enough of a change to affect monetary or fiscal policy, so the FX impact is likely to be ephemeral at best. Japan's current account surplus, or Japan's current account, comes out at the same time. On a seasonally adjusted basis, the surplus is expected to rise notably, although this is a fall on a seasonally unadjusted basis. Watch then for how it does relative to expectations, not on an absolute level. The trade data from other Asian countries has been disappointing recently. In cases where trade surpluses are rising, it's only because imports are falling faster than exports, not because exports are rising. Now, China's trade data is expected to confirm that trend, as both exports and imports fall, but imports fall faster. The higher trade surplus in China could benefit the Australian dollar and also emerging market currencies on a reflexive basis if investors pay attention to the headline without noticing the details so much. Nonetheless, the Chinese authorities may well welcome the rising trade surplus, regardless of its cause, in order to prevent any depreciation of the renminbi. That's because China is embroiled in a trade dispute about their steel exports. The U.S. is investigating whether Chinese manufacturers hacked into U.S. steel producers' computers and stole trade secrets. The Chinese may want to fend off even more trade tensions by keeping the currency firm. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.